Central bank policy is often described as tight or loose, and understanding these two settings makes central bank decisions far easier to follow. They are essentially the two directions in which a central bank can steer. Loose or expansionary monetary policy means the central bank is trying to stimulate the economy. It does this by making money cheaper and more plentiful, chiefly by lowering interest rates, and sometimes by adding money to the system. Cheaper borrowing encourages people and businesses to borrow, spend, and invest more, boosting economic activity and employment. Loose policy is typically used when the economy is weak or inflation is too low. Tight or contractionary monetary policy is the opposite. Here the central bank is trying to slow the economy down, usually to fight high inflation. It does this by making money more expensive and less plentiful, chiefly by raising interest rates. Costlier borrowing leads people and businesses to borrow and spend less, cooling demand and easing the upward pressure on prices. Tight policy is typically used when inflation is too high or the economy is overheating. So the two settings serve opposite purposes, loosening to warm up a cold economy, tightening to cool down a hot one. A central bank switches between them or adjusts the degree based on its reading of conditions, above all, the balance between inflation and economic strength. For example, when inflation surges, a central bank tightens by raising rates to cool spending. When a recession hits, it loosens by cutting rates to revive activity. Opposite settings for opposite problems. Central bank mandates, tools, and targets vary from one country to another, and they change with economic conditions. Even economists disagree about how policy and money creation really work, so check which institution sets the rules where you live. The main lesson is simple. Tight monetary policy slows the economy to fight inflation, while loose policy stimulates it to support growth, and central banks switch between them depending on what the economy needs.